Hi everyone, it's Jack back with another video, and today I'm talking about TSMC, Taiwan semiconductor manufacturing company, arguably one of the most important companies to the world economy, and it's been through the ringer this year, down 51%. It's down around, between 5 and 8% today, depending on what time you're looking, because some continued problems with US-China relations and what that means for trade and what that means for Taiwan semiconductor. However, this is clearly an absolutely fantastic business that is central to the world economy going forward, producing, the numbers differ, but the majority of semiconductors for fabless manufacturers like Apple, for example, they produce the M1 chips, they produce chips for Amazon's data centers, they produce Nvidia's chips, AMD's, they produce chips from the majority of fabless companies. Currently, it's trading at a PE of below the S&P 500, a 3.7% dividend yield, and is now just a $320 billion company. Absolutely staggering losses this year, right at its 52-week low pretty much, way off that high of $145. Definitely some opportunities back here, so I want to look at what the outlook for this company is, its balance sheet, its debt load, its valuation, do a DCF, and decide if the risks are worthwhile and if this company is a good company at this price. So today's sell-off, which as you see in there is around 8%, mainly after Joe Biden announced further restrictions on exports to China. Of course, the 50% drop is kind of threefold. General fall in the stock market, the S&P 500 is down over 20%. Some concerns over US-China relations, and primarily the fact that the Russian invasion of Ukraine may have potentially opened the doors to a Chinese invasion of Taiwan, which they've been posturing for a long time. Of course, this is pure speculation, but the risk of this has never really been higher. Looking at the geopolitical situation, it's certainly a huge risk for TSMC. TSMC is something like 90% of Taiwan's GDP. Its market cap is 90% of Taiwan's GDP. It's an incredibly important company for that economy, and it's basically Taiwan's economic miracle. This company is absolutely central to Taiwan and is one of its biggest employers. It would be a catastrophe if this company was impaired by China. A catastrophe for the world economy, absolutely. So that is a material risk. But the other risks, restrictions on exports to China, I don't think this is going to affect TSMC in the medium to long term. And I think the stock market is just presenting us with a reasonable opportunity to buy this, albeit with the risk of exposure to a geopolitical risk. While it's no secret that we're in a tough economic environment and market conditions are worsening for the likes of TSMC, in the most recent report, which was Q2 2022, they performed fairly well versus their guidance, $18.16 billion of net revenue. That's on the upper end of their guidance. Net and gross margin 59% above their guidance figure, and an operating margin of 49.1%, again above the guidance figure by a decent amount. And they predicted that this was going to stay the same for Q3. They haven't guided down as of yet, and they predicted net revenue in the $20 billion range. Usefully, it's not something you see very often. TSMC reports its monthly revenue every month, with the most recent data being the full month of September, where they recorded 208 million new Taiwan dollars, which is about 32 to 1 with USD, so 208 is about $6.5 billion. Now you can see on the right hand side the year-over-year change is clearly coming down. That's still a 36% gain on the year before on the revenue, which is absolutely spectacular. At 50% gross margins, that's a frightening amount of operating margin they're taking home. Now, if they continue to do this in October as well, they'll probably hit their guidance, or they'll be very close to doing that. So we're not really seeing the effects of a global economic slowdown. I think what we're seeing with the stock price drop is a bit of fear and a lot of the risk about Taiwan and US trade restrictions going forward, and less about the performance of this business. Because I don't believe, as I mentioned in my last video about AMD, I don't believe that semiconductors are as cyclical an industry as they once were. They're less tied to PC upgrade cycles and iPhone upgrade cycles and blah, 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 because everything has semiconductors in them now. So it's far more likely that this is a less cyclical industry than it once was, and that Taiwan Semiconductor is just chugging along as it normally would, perhaps at a lower rate of growth, but still chugging along quite well. Looking at the valuation and margin profile, P ratio on a trailing basis of 13, on a forward basis 11. This forward basis requires a bit of projection because of how changeable the market conditions are right now. But if we go off the trailing figure of 13, that's still significantly below the S&P 500 averages right now, which is around 18 on a trailing basis. For a company with a gross margin of 55%, absolute dominance. They're the only company producing 3nm chips. They have a huge technological lead and a 41% net margin nearly. This is a fabulous business and deserves to be trading at a significant premium to the S&P 500. I think the only reason it really isn't is over geopolitical concerns with Taiwan and China. You look at that PEG ratio, 1.15, which is almost bargain territory of under 1 for a company that is. It is no secret this is central to the global economy. It is clearly underpriced on this basis because people are concerned about the inherent risk with this business. Has a return on invested capital percentage of 32.5%, which is absolutely outstanding. It's been profitable every year for the last 10 years. Return on assets, this is obviously a very, very, very asset-heavy business. 21% return on assets, which is absolutely outstanding. And return on equity percentage of nearly 35%. All these metrics are absolutely fabulous for any industry, particularly for the semiconductor industry, and they're very, very strong for TSMC's historical metrics. The management here is excellent, and they continue to push that technological lead, and I really can't see them slowing down. This is going to be an incredibly hard company to disrupt over the long term. Balance sheet wise, one might say this is a slight chink in the armour. This is by no means the best balance sheet in the world. Cash to debt ratio of around 1.6, not particularly impressive at all. They have around $30 billion in debt. This is a very capex heavy industry. You can imagine the machines from ASML and Lam Research and Tokyo Electron blah blah run into the millions and millions of dollars. So it's by no surprise whatsoever that it's a very capex intensive business, very R&D focused business, very asset heavy business, and this requires a large cash load, a large dedication of free cash flow, and sometimes taking on some debt. The debt has steadily increased over the last few years, but is not at a concerning level, in my opinion, right now. It is very, very well covered by EBIT. You look at the interest coverage, they could pay off 98 years of interest with this year's EBIT, so there's no concern there. Although, with rising interest rate environment, this could become more of a concern. But this is an incredibly high net margin business, very free cash flow positive, and has almost $50 billion in cash on the balance sheet, so way more than debt. So I'm not overly concerned here. Nearly $20 billion in net cash, so no real concerns for me. And this reflecting an Altman score of nearly 5.7, meaning this company is safe from immediate term financial distress. Next, to do a DCF to work out a fair value for this business based on the sum of its future cash flows. I think a relatively conservative and safe number to do here is a 10% free cash flow growth rate. Over the last 10 years, they've averaged a 23% free cash flow growth rate. I don't think that they can sustain this going forward, in truth. I think an achievable number is between 12 and 15%. I think a more conservative number would be 10%, for example. I think this is completely sensible and something they can achieve over the long term, especially when you see that the 10-year revenue growth is around 12.5%, and the incredible tailwinds this company has with the growth of the growth in use of semiconductors going forward, and seemingly very little competition for the high end. I think this company has a lot of free cash flow generation potential. Using that 10% free cash flow average growth rate, a 9% discount rate for long-term returns to the stock market, that gives a fair value of $64.91, or pretty much the stock price right now of $63. Again, not outstanding value, but a pretty rare opportunity to get this company when it's far below its average PE ratios. So while this business is an incredible performer on a purely stock returns basis, 17.5% revenue compound annual growth rate since its listing in 1994, and 17% earnings growth since this time. They continue to hit the strategic investment. They have a very high credit rating, and they have plenty of money to finance organic growth, and they are generally highly disciplined in mergers and acquisitions and just don't do anything stupid. It's a great management team. They've also been paying a decently sized and growing dividend that's been growing since 2004. They've never reduced this on a dividend per share basis. The growth rate over the last 10 years averaged 17.5%, which is absolutely outstanding, and right now sits at a pretty juicy 3.7% because of the decrease in the stock price. So it seems like an optimum time to lock in this dividend yield, in my opinion, and that's why I've been buying this stock in little chunks. I'm not going mad because I do think there's some material risk to this company, no doubt, but I think there's an excellent opportunity. So it's clear that I think this is a fantastic business that's going to be incredibly hard to disrupt for the likes of Intel and Samsung to catch it, because it has such an incredible technology lead and is so central to the world economy with long-term secular tailwinds that I just believe this is going to be a long-term winner. Of course, it is not without risks. The the way the wind is blowing is looking towards the end of globalization. Many countries are looking to secure their own semiconductor manufacturing supply. For example, with the CHIPS Act in America, that's going to really boost companies like Intel or smaller companies to produce their own semiconductor and move manufacture away from the likes of TSMC. However, I just can't really see them being able to catch TSMC in the medium term. It just seems so unlikely. With the bear in mind, Intel is 7 nanometer. They have to use the process knowledge from 7 to get to 5 to get to 3. TSMC are already there and are looking to push further. They have such a large technology advantage that really is a moat versus companies like Intel. I just can't really see the likes of Apple wanting to sacrifice performance and product innovation for the sake of using the internal supply. But this is nevertheless a material risk. Also a material risk is it being in Taiwan, which is a source of geopolitical tension, mainly based in Taiwan. And this is just something you will have to be okay with if you're going to own this stock. That is a material risk. When you're getting a company like this for a 13 PE ratio, of course there is a catch, and that I believe is the biggest catch. A lesser catch, in my opinion, is the inherent cyclicality of the semiconductor industry. In the past, could you be buying at the top of a cycle? In this case, I don't believe that to be the case. It's trading for a PE around 13. I don't believe that TSMC is suddenly going to lose 20% revenue. The world relies on this company so incredibly heavily right now, and is going to continue. So I don't really see the semiconductor industry being as cyclical as it previously has been, as mentioned earlier. Previously more reliant on PC upgrade cycles, iPhone upgrade cycles. That's just not the case anymore. Everything has semiconductors in it, and there is a constant need. I think TSMC has long-term tailwinds. I think these are going to continue to pay dividends for this company, and it will continue to pay dividends at a really nice rate, 3.7%, PE ratio around 13, trading at roughly fair value. I really like this company, and I'm going to continue to add to this startup position I started a couple of days ago. That being said, none of this is financial advice. You should do your own research and due diligence. Let me know what you think of TSMC. Let me know what you think of the risks. Let me know in the comments down below. Like and subscribe if you're enjoying. I'll see you again next time.